Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jordan, a partner here at the firm. Eric, you see a lot of taxes, right?
We do.
Like, how many do you see a year?
Oh, me personally?
Yeah.
I probably hear the tax situations for easily hundreds and hundreds of business owners.
So like 150, 200, 300-ish?
Well, all to a certain different degree, but it could be as many as 500 plus.
Okay. But you physically see maybe like 100?
Yeah, probably. Okay. Probably 100 where I'm involved.
Okay. So tax planning is a big deal then.
Absolutely.
As a business. Right?
Absolutely.
And you see what happens when that doesn't happen.
Correct. And there's also a lot of misconceptions around what tax planning is and what is involved. And you'll see a lot of maybe discussion or advertising about tax planning. And a lot of it is around these big complex schemes and ideas and different things, right? You hear about, people moving their operations overseas to avoid tax or,
that island in the Cayman Islands, right? Building in the Cayman Islands.
Yep. And, like some of the ultra wealthy and what they do, or they leverage their assets. They don't draw any income from assets, and they leverage them.
They take out a loan on their interest or something like that.
Correct.
Which can't be taxed.
Yeah.
Don't tell me that you have some knowledge on that.
Private foundations or all this stuff, which, there's a fit for all this type of stuff in somebody's tax strategy. To 95% of probably 99.9%.
I would say 99.9 of the rest of the world.
Small business owners. Yep. Tax planning revolves around like 5 topics.
And what are those?
So 40% of it for small business owners is just having good bookkeeping, really solid books. We evaluate tax situations and books for small business owners every day. And most opportunities and errors just come from bad bookkeeping.
Just clerical errors or just not keeping up to date.
Organization is a big one, like missing information data, not understanding how things are supposed to be handled. Sometimes it's the process where, hey, we're doing all our bookkeeping during tax season, very good opportunity to miss things, just all sorts of things like that. But 40%, we believe, of good tax planning revolves just around having proper, clean set of books. Wow. Next 20%, I'd say, is just having the proper entity and compensation structure. That's kind of one of those things where it's the initial build and you can generally set it and forget it, except for changes that happen. But about 20% of opportunities that we see are just one of those two things. I'm in the wrong entity type. I haven't made the progress to the entity type I should be, or maybe my compensation structure isn't set up as efficiently as it should be.
And those are something that could get fixed, and they could see those results within a year.
Correct.
Yeah.
Yep. So, we're just starting the new year. Really good time to look at my entity structure and my compensation structure before we're at the end of the year. And we're kicking the can down the road a whole nother year then.
Yep.
So we're already at 60% between good bookkeeping and good entity structure. Okay. 15% is just having good quarterly estimated taxes, right? Did we pay in at least the safe harbor? And then are we prepared to pay whatever incremental bill might come on April 15th from those safe harbor estimates? So that's just having a good tax relationship, I guess I would say, being prepared for what taxes that you will owe and avoiding underpayment of an estimated tax penalty.
And honestly, that piggybacks off the 40% of booking, right?
Yeah.
You couldn't even get that 15% without the 40% before.
Yeah, exactly. Right. If you don't have good bookkeeping, it's really hard to get proper estimated tax payments. And maybe you're on the other end and you've way overpaid them because you've had a really down year. Well, geez, in a bad year, wouldn't you really like to hold on to your cash?
It's really hard to get cash back. Yeah. I find anytime it leaves your hand, it's really hard to get it back.
To get money back from the IRS does take some extreme effort.
Well, and anytime that, we just talked about HSAs, I pick pre-tax because I'm like, well, that's something I know I'm getting right now.
Yep.
The other one, post-tax, takes the work to get it back.
Correct.
So,
next 15% is some of those year-end planning items, right? Right. As you're getting towards the end of the year, do we need to make some improvements? Need to replace some equipment? Anything that needs to go out the door? Profit sharing, or bonuses for your staff?
I typically see a lot of swag getting purchased at the end of the year too.
Yep. Good opportunity, right? Hey, if I know I'm going to need this in the next year, and for sure, if I'm a cash basis taxpayer, right, we want to accelerate paying of expenses and defer receiving income, right? And that's a year-end planning strategy that we're talking with in November, December. So that's about 15%. Then the last 10% is just making sure retirement plans are set up and we're putting the proper amount of money into retirement plans. Maybe we are doing a retirement-based profit share plan contribution for our company. Again, all these things are normal things, right? Most businesses out there they need to have books done. They need to have a good entity structure. If they're profitable, they need to pay quarterly estimated taxes. They should be talking before the end of the year about any spending that they might need for their business use and how do we tax maximize that spending. And then retirement plans.
Okay.
All these are standard items. Nothing is this weird, outlandish, crazy strategy.
It's nothing too out of the realm for anybody.
Exactly.
Really. Exactly. So please tell me you have some examples.
Yeah. Because we feel so strongly about this breakdown of tax planning, we just grab some anecdote. And this is just stuff that we've seen in less than the last 12 months, probably in the last 3 or 4 months, from clients that came to us and maybe some of the results that we found and or realized for them. Number one is just the proper bookkeeping. And this is just making sure that you're reconciling every single account that exists for that business. So a shop owner came to us with a QuickBooks file that they just handed the accountant at tax season. They filed the returns exactly off that.
So it was just
QuickBooks
going
file.
to an accountant.
Yep.
Just normal accountant. Okay.
Normal accountant, tax preparer, and they literally ran the balance sheet, P&L, slapped in a return, fired away.
Yep.
Well, we went back through and we said, oh, hey, why are we expensing some of where are these credit card payments going? Like, what, do you got a business credit card? Yes. Turns out there's a whole credit card missing $34,000 of expenses from that credit card.
Oh.
Let's just assume a 35% effective tax rate. It's $12,000 in missed tax savings. That's just from bad bookkeeping.
And they can get that back though, right? They can reach out.
Correct. So so this was somebody that they had not filed the return yet. So we were able to go through, so there's something we do called back work. If there's an open period or if we think there's an open period, we'll actually go through and go back and redo the books from soup to nuts for that period because of opportunities we find like this. Right. And it would have I think it cost them a lot less than $12,000 for us to go do that back work. And we found that $12,000 just on that one item. And now we also have good historical data on that business, which we can help them make good business decisions off of.
Prepared for the future then.
Exactly. So that very basic, right? That's just bookkeeping. The owner comp structure. So we have a business owner brought us their tax return for review. They said, hey, I don't think I'm getting good tax advice anymore. So we looked. The owner was paying themselves a W-2 compensation of $183,000. Spouse had a W-2 compensation of $65,000. In discussion with them about their business structure, they're very hands off. They have a COO running most of the business. They have multiple leaders that are doing things. So they're really not having to provide services to the business. So really, they're sitting purely in that business owner seat. So we said, hey, we don't need to pay ourselves that much on a W-2. We can actually bring your W-2 compensation down. $60,000, we think, from the owner standpoint, $41,000 for the spouse. We were able to gross up the owner's W-2 a little bit with their health insurance premiums and other benefits that they were taking. But running this model and reorganizing this compensation structure, we realized between FICA savings, something called a qualified business income deduction, pass-through entity taxation benefits, $31,000 in tax savings just from restructuring. Money that they're already paying themselves, right? They didn't have to do anything new. Mm-hmm. They just had to change the way they did it. $31,000 in tax savings.
That's huge.
Absolutely. Simple, and it's a simple thing. We talked on a prior podcast about depreciation. Mm-hmm. One of the biggest things we see with mistakes around bookkeeping is not handling the purchasing of equipment on debt properly. I went back, I found two examples that we caught. So one of them was somebody bought a Ford F-250, big, heavy truck. It was October 23. The bookkeeping was just expensing the payments. Okay. So they made 3 payments. It was like $1,000 a month. So we saw this and we asked for the purchase paperwork, business vehicle. We set up the loan schedule and all that. We added the whole truck, which was $73,000 as an asset. And then we accelerated the depreciation on it. So if they would have just submitted their tax return with expensing the payments, they would have about $1,100 tax savings in the purchase of that truck in that year. The way we did it, we came up with about a $25,000 tax write-off or tax savings for that year. So we wrote off the whole truck, $73,000 at that 35%, $25,000 tax savings just from, again, good bookkeeping.
Yep.
Similar story. Somebody bought a lift, like a vehicle repair lift. Mm-hmm. So they bought it through Manapa, which is normally for them parts vendors. And they were just, again, it was on their statement. It's just another bill. So they wrote the check, went to parts cost. Again, we found the lift. The lift was about $10,000. They had only paid in about 1,200 payments at 35%. That's $431 of a tax write-off versus what we were able to do is $3,500 just by proper accounting for equipment that was bought on debt. Mm-hmm. So basic bookkeeping, huge tax savings. These are all extremely tangible. Here's something that I see from preparers a lot too. So I think this is our final example. They don't like to venture a lot of times into areas they're not super comfortable with. And one of those areas is something called a cost segregation study.
Oh, cost segregation.
Yeah.
We've covered this before.
We have. And we had a client, mm-hmm. Their prior preparer had said, well, it was a new client to us, but their prior preparer had said, I don't think it's worth the while.
Okay.
And they just followed that advice. I took a look at this and I said, our barometer is if it's over $1 million, it's almost always going to be beneficial to do a cost
for a building, right?
Study.
For do cost.
Correct.
Yes, cost
yep. So they had built a whole separate office for their business. Built out a huge office. It was $1.4 million. I said, I think we're gonna get some good benefit out of this. So we sent it to our partner that we use, Alternative Tax Solutions. They've been on the podcast. Shout out to them. We sent it out and they came out with an estimated year one tax savings after the cost segregation study was between $64,000 and $92,000, and their fee to do this study was $6,600. And I believe that after the study was completed, it came in around a $95,000 tax benefit. So we're talking about,
and that's just the first year.
That's just the first year benefit. Correct. I think that's about a 22x return on investment on that cost segregation study. And then
that can also be accelerated too, right?
Well, that's what so there was actually about, close to $300,000 of
total
things that we could accelerate the depreciation on. And actually I just talked with somebody yesterday that had bought 3 buildings in Seattle. Mm-hmm. And I'm like, well, it's got to be, our barometer is usually $1 million. He's like, we're Seattle. Of course they were. You buy a shoebox in Seattle for $1 million. I think he had bought about almost nearly $5 million in real estate. And his accountant said, not worth it because of the auto repair. Mm-hmm. And I'm like, I think we can find some nice benefits on about $5 million of real estate for a cost segregation study. And the good part about those is we can catch up from the past, right? Mm-hmm. So if you bought a property 2-3 years ago, we can still do a cost segregation study for the current year. Mm-hmm. So it's just sometimes people operate in what they're comfortable with.
They're comfortable with, yeah.
Yeah.
Well, and the nice thing was that we have 39 years on a building.
Yeah, a nice long-term,
you can get some money back on it.
Yeah. Yeah, absolutely.
Well, that's fun. Eric, anything else you want to cover?
Again, it's all about having conversations with, pick up the phone, call your accountant. That's my number one, please. Do that. Run all your scenarios by them. Sit down with them. Review your plan for the end of the year when it comes to end of year. Review a plan and create a good plan to kick off the new year. You should be able to come up with strategies. Tell them what you have going on, what you want to do, what you want to accomplish. And we as practitioners should be able to come up with a plan to maximize where you're at from a tax position standpoint.
Thank you very much, Eric.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.